Hi, I'm Whitney Espich, the CEO of the MIT Alumni Association, and I hope you enjoy this digital production created for alumni and friends like you.
Welcome everyone to today's webinar. My name is Sayuri Sharper and I am the president of the alumni group. Our topic today is what is impact investing? And I am very pleased to have Adam Bendell, CEO of Toniic, and Eric Stephenson, co-chair of Quartz Foundation and director of client services at Align Impact, here to lead the discussions. Since we only have very limited amount of time, I will keep the introduction very brief, hopefully just 5 minutes. So we'll start with a quick review of SEAG before presentations by Adam and Eric. You can submit your questions using the Q&A feature of Zoom. Unfortunately, we can't respond to these questions live, but we will go through as many of them as we can after the formal presentation. You will get a copy of today's presentation emailed to you after the webinar, so don't worry because some of them have lots of words just to get the information to you, especially from me. Again, in order to make this webinar very informative, the intro will be very short. The presentation will be emailed and the video will be available on MIT's YouTube channel. So let me go to the next slide. So who is SEAG? What do we do? There are, again, lots of word on this slide, but we're not going to go through it. One thing you should know probably is that the alumni group is under the MIT Alumni Association, and we have the staff of the Alumni Association to thank for helping us get these webinars set up. But in a nutshell, our goal is to create a community around MIT that supports social entrepreneurship, including current students, staff, and alumni, as well as others that desire to be part of our community. So we encourage your continued involvement with us, and we have some interesting programs that are planned for the rest of the year. Here are SEAG's current officers. Lisa and Esther are also on the SEAG board. I started SEAG last year around October, and I am so thankful that I'm joined by 4 wonderful alumni. They are all attending the webinars today, and I encourage you to get to know them as well. So how do you get engaged? Well, last year was our formation year, and we just had a couple of webinars and about 200 folk sign up to be part of SEAG. This year, we're kicking up the activities with monthly webinars on both Impact Investor track and Social Entrepreneur track. Feel free to watch both. I think as an impact investor or potential investor, you might want to get to know what are the struggles and what are issues that social entrepreneurs face, and vice versa. For social entrepreneur, it will be interesting to understand the investor's perspective. But as we go, rather than these one-to-many type of communications, we want to be a more interactive community who can have ad hoc discussions and share experiences and best practices. So those are our going into later this year and next year. And if you are interested in helping us build our community, please contact Esther. Her email address is here. And again, it'll be on the handout for ways to volunteer and help us build out this wonderful community. Here is how to join. And again, all this information will be on the handout. So I encourage you to refer to that. And if you have any question, one is ready to help you and sign up for being part of our community. So now I'd like to introduce Adam, who is going to start us off. Adam.
Hey, good morning or afternoon, everyone, wherever you may be. It's a pleasure to have the opportunity to speak with you today about impact investing. I'm going to get my slides going here. And so I am the CEO of an organization called Toniic. Toniic is a leading network of active impact investors consisting of high net worth individuals, family offices, and foundations who all consider themselves to be active impact investors seeking deep impact across their entire investment portfolio and in their lives. And my own journey to this space was initially as an entrepreneur. I started a couple of companies and was successfully exited. And when I first came into wealth myself, I had this sense that there was an opportunity to use my resources not only to continue to feather my own nest, but also to address big world problems in some way. And so I became an active impact investor individually, although I was still at that time very busily consumed in a big job in a public company into which my last startup merged. And so it took me a while to make this into my full-time occupation, but I joined Toniic about 3 years ago as CEO as an opportunity to really spend all of my working life and passion on this field of impact investing that I feel has so much promise to address big world problems alongside philanthropy. So Toniic's vision is a world in which all investments honor the planet and its inhabitants. It's our fervent hope that at some point in the future, we won't be talking about impact investing, but rather just investing. And it would be odd if someone considering an investment portfolio did not consider their values and what might be achieved with resources beyond just making more money. But that's not where we are today. Today, that is a minority view rather than the way that investing is done by default. And so we at Toniic aim to change that. So I'm going to spend my time here this morning giving you a very brief overview, obviously, because I have just 15 or 20 minutes to talk about what impact investing is. And then I know that Eric will show you something very interesting, which I have seen before in terms of how to think about an impact investing portfolio. You should, in the interest of full disclosure, both Sayuri and Eric are Toniic members and active ones at that. So we're a little bit the choir preaching to one another.
Proud ones at that as well.
Proud ones. Thank you, Eric. But we're gonna zip along here and just talk very briefly about how to think about what impact investing is. So what are impact investments? They're investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. And this is a definition developed by the Global Impact Investing Network probably 10 years ago, which has held pretty steady as a kind of lighthouse for our field to think about what an impact investment is and is not. Now, one of the places so that's clear enough, and then let the confusion begin, because there are all different kinds of terms, green investing, sustainable investing, responsible investing, ESG, SRI, acronym soup. How do I think about how these things relate to one another? And so I'm going to try to give you at least one relatively simplified view of that here, which is essentially what's the difference between impact investing and sustainable investing, or investing with an environmental, social, or governance lens. And the simple answer to that is depth of impact, the depth of impact that active impact investors are seeking. So take a look at this, this drawing here, which is a way to visualize the different approaches to investing with a mission broader than simply making more money. So ESG, environmental, social, and governance investing, is generally concerned only with risks that might impact financial performance in the medium term. So these would be social or environmental risks. For example, the risk that a carbon tax would come into effect in one or more developed worlds provides a pretty substantial risk of stranded assets for fossil fuel companies, that reserves that are on their balance sheets today will never be able to be extracted because it will simply not be economically viable to do so. That is obviously an environmental risk, and climate change and averting it is high on the list of many impact investors. Yet what's distinct about that example is that it will resolve to financial risk for the fossil fuel companies that are involved. So that's an example of a environmental or social risk that will or may resolve into a financial impact on the affected or invested company, not necessarily in the short term, but before too long. That's distinct from what we call values-aligned investments, which are investments that that do align with the investor's values. And there's an additional lens on top of that these are best-in-class companies, that they conduct their operations with care for all stakeholders, for customers, for suppliers, for their employees, the communities in which they operate, and in addition to that, investors. And for those of you who follow the mainstream business press, you may have noticed in perhaps it's 2 weeks ago or 3 now, that the Business Roundtable, which is a quite prestigious gathering or grouping of big company CEOs in the United States, finally adopted this stakeholder view of who they serve. And so until that time, they had quite strenuously resisted the thought that they serve anyone other than their investors, that their goal is anything other than making as much money as possible for investors, whether that's raising the share price or looking after their debt investors. And now even these mainstream CEOs of the Business Roundtable have embraced this stakeholder model. So that's a big step forward for sustainable investing generally. And it is yet distinct from impact investing. So an impact investment, or one that makes a direct contribution, not only invests in a best-in-class company or aligns with the investor's values, but also seeks to solve a big world problem. And that is typically a problem that can be aligned with the UN Sustainable Development Goals, a group of 17 big world problems that were identified in 2015 by the United Nations, with targets for 2030 of specific progress. And most impact investors can now talk about their impact investing portfolio through a lens of sustainable development goals. And so that's because these investments are aimed at solving a big world problem. In addition to being an impact investment, the investor can articulate a theory of change that by doing this or investing in this particular company, we expect to have this kind of output and ultimately an outcome that we think will be an improvement to the state of the world in some way. And finally, an impact investor commits to measure impact in some way. And not just the positive ones, but the negative ones as well, seeking to pursue positive net impact across each and all of their impact investments. And I encourage you, if any of this is confusing or you'd like to drill deeper, to just make a note for yourself, because we're going to cruise along here and then have opportunity at the end of the hour to answer questions. So this question is one that we hear a lot, which is impact investing simply making direct investments in social enterprises? And the answer to that is no. Impact investing is a lens across all asset classes. There are many impact investors, the kind of early and classic ones, who focus very deeply on providing supporting capital to social entrepreneurs in the developing world in particular, or in general. But if it solves a big world problem, if you've got a theory of change, if you commit to measuring impact, then from our point of view, that is an impact investment, an impact, and is making a contribution. So another question that we get commonly is all impact investing aiming for below market rate returns? Is impact investing necessarily concessionary investing? And again, the answer to that question is nope. Actually, impact investing occurs across the spectrum of capital. So I'm showing you here a framework developed by Omidyar Network, one of the leading family offices, essentially, of the impact investing space. And they developed this framework, which has been widely referenced, of the continuum of capital. So you see here on the left, commercial rate returns, in the middle sub-commercial, and on the far right, grants. And that's because particularly for a impact-oriented or philanthropically oriented family office or foundation, you tend to think across the entire spectrum of capital, from commercial all the way through philanthropy and grant making. What we find from an impact investing perspective is that institutional investors are often limited, or consider themselves limited, to this market-validated commercial rate return area of the spectrum. Whereas the folks that Toniic represents, which is individuals, family offices, and foundations, are often seeking appropriate returns with a more nuanced view of whether to insist upon market rate returns in a particular investment or not. And they are very frequently, even if a portfolio as a whole targets market rate returns, our members are very frequently making sub-commercial investments in particular investments in order to achieve deeper impact, and tend to talk and think about achieving appropriate returns rather than market rate returns, because market rate returns have this rather unpleasant for the world a feature of externalities, that the negative costs that are not borne directly by the firm are borne instead by society as a whole. Pollution is the classic example of an externality, and impact investors think about internalizing those externalities and taking into account the net impact of their investments, not only the financial return. And so we have a lot of argument with folks who say my fiduciary obligation requires that I look only at market rate or better investments, but we won't dig into that rabbit hole today, merely to point out that the broad sweep of private investors do not typically consider themselves so limited and are looking across the continuum of capital or the spectrum of capital. And then just to say, obviously grant making is philanthropy, but you can also look at it from the lens of investing. A grant is a 100% investment loss. And so while impact investors are very often themselves also philanthropists, they see this opportunity to use the tremendous mechanism of business and capitalism to leverage their resources in solving big world problems, and hence the desire to get a financial return alongside social or environmental impact, even if that financial return might be somewhat less than what is considered market rate for that particular asset class. So with that introduction, I talk a little bit about, if you are interested in impact investing, how do you get started? And the answer to that question is different for retail investors and for so-called accredited investors. So accredited investors is a legal definition by the Securities and Exchange Commission in the United States. There is a similar framework in most other countries in the world that is designed to identify investors who are sufficiently sophisticated to be trusted to make a determination about the risks inherent in private investments. So as you probably know, there's this broad distinction between private and public investments. Public investments are those that have been validated. The offering has been reviewed by the Securities and Exchange Commission in the United States, or the securities body of whatever country is the domicile of the issuer. And that review process is designed to ensure protections for investors who might not have the sophistication or the level of assets necessary to protect their own interests. The idea is that private investments, and many impact investments are private, so they're not listed on a stock exchange. They do not have daily liquidity or even periodic liquidity. It might be a very long lockup of a 10-year or longer period before you can get your money back. The framework is set that those sorts of investments are reserved for what are called accredited investors, essentially high net worth individuals who can bear the risk of loss, both entire loss or partial loss of investments, who can understand with their level of sophistication the relative trade-offs of risk and return. And so for those investors, there's additional options than there are for retail investors. So for a retail investor, you'll typically be limited initially to publicly listed investments. And in that case, our recommendation is to start with ESG, to start by choosing funds typically that have been screened for environmental, social, and governance issues. And that's a great way to start. The process for both retail investors and accredited investors alike is one that begins with clarifying your values. So we would not at Toniic seek to tell somebody what they should believe in, but rather to support them in investing in alignment with those beliefs. And so that is a process that each person embarking on the impact investing journey needs to determine for themselves. But there is a starting point by picking funds that are screening in a broad way for these kinds of issues, and that's our recommendation for how to get started as a retail investor. And the final thing I'll mention there is to simply check what's available in your 401k if you have one of those. The options are not always available to have a screened fund that focuses on risks that traditional investors view as externalities. If that's not the case, you can sometimes self-direct in your 401k and pick your own portfolio or set of tools that will allow you to narrow down the scope of things and not be making investments that you really don't believe in or that don't take into account the externalities or risks that are imposed upon society. For a high net worth individual, it's a bit different. There, you have the opportunity to find a group, a guide, an advisor, but someone who can help you to deploy your capital with this kind of lens. Again, you still need to clarify your values and really get clear about where you can have the most impact, where you can really move the needle. We typically advise those who are just getting started to pick one asset class and start there, whether that's public equities or whether that's to do some early stage private investing. It's up to you, but the point is to get started because it can be overwhelming to try to transform a traditional portfolio. And so the old saw about how you eat an elephant is one bite at a time, which actually sounds pretty disgusting, but that's the saw. We say, sort of take one asset class at a time. And we do encourage people these days to consider funds. In the earlier days of impact investing 10 years ago, it was very common for people to begin by just making one-off direct investments. That's still wonderful and a ton of fun and a great way to get engaged with the impact investing space. But that type of investing, making direct private equity investments in early stage social ventures, is really going to be appropriate only for a relatively small percentage of your total net worth or your portfolio. There's a learning curve there, and it's not necessarily the easiest place to start. So we don't discourage people from doing that, but if you're thinking about how do I transform my portfolio, the early stage investing is probably not going to do that. But we'll add a great deal of expertise and experience for you and really give you a taste of why this approach to investing is so attractive to a number of people, why they see impact investing as a way that they can really use their resources for good in the world. So I'm going to stop there for now and turn it over to Eric. And we'll have some opportunity for questions at the end.
Great. Thanks, Adam. And I think, so I had a bunch of stuff planned, but after hearing Adam speak, I feel like I'm throwing it out the window and I started writing a bunch of other stuff down. So I'd love to just pick up on one thing, right? Impact investing isn't just investing, right? I think I once heard someone say impact is being present in all that you do. And we carried on the conversation to say you really have time, talent, and treasure. Those things, you have to step back and say, okay, how am I either lending, spending, or giving these things away, right? What's the impact of you lending, spending, or giving away your time, talent, or treasure? So that goes beyond investing to being a conscious consumer, et cetera. So, it's not just money that makes you an impact investor. It's like the old analogy, if you have a hammer, everything's a nail. I heard Jed Emerson say, if you have philanthropic money to give away, everything's not a charity case, right? So there's multiple ways you can use your capital for good in this world, from being a consumer to lending it to responsible institutions to helping family out in building social enterprises, and the list goes on. So those thoughts were just spurred after listening to you, Adam. And I have to say, we've been on this journey through membership networks like Toniic, which has really become a community. So let me introduce myself. My name is Eric Stephenson. I co-chair a family foundation with my wife, Steph Cordes. The foundation is called the Cordes Foundation. It was founded by her parents, and we both met doing this impact investing work and being members of Toniic. And I do say we take pride. I think we are the first married couple to come out of the Toniic membership. We look at it as a peer-to-peer learning and action group, getting together and saying, hey, how are you doing this? We have concerns, and we're talking about some really private things here. Can we trust you to, one, keep our confidentiality and really be direct with us? Tell us what you've learned in your journey. What are some bumps that we can avoid in making true impact with the assets we have? So today we do a couple things. Right now, my wife works with an ethical fashion firm and helping grow that. I also work with a firm called Align Impact, which is working with about 30 families today on their impact investing journeys and implementation. I like to say in all the things that we're doing with Align, we're woke and bespoke, right? How do you become woke to the issues you and your family members care about? And then how do you create a bespoke portfolio around that, which is what I'm going to show you today with our Cordis Foundation portfolio, right? How do we dive deep into the issues we cared about as a family and then create a bespoke portfolio across asset classes that took into consideration the traditional investing principles of risk and return, but say, hey, it's not just those two things. We have to look at impact as well. So risk, return, impact are the three things we look at, in addition to a bunch of other risks and exposures that I'll show you. Liquidity, right? Geographical exposure, sector exposure, all those kind of things. So let me share my screen here and we'll dive into our portfolio. And please feel free to ask any questions. The Q&A is open. I have it open on my computer. So if I don't answer your question, it's because it was too hard and I'll share it with Adam. Okay, one sec, share screen. Okay. Hey, Adam, can you see my screen? Can you not? I see you on video there. Great. Okay, so what we did here, let me refresh the page. And this is the dashboard you might see in any traditional investment portfolio. And that's because we really look at impact investing as that second word implies, right? It is investing. And as an investor, you have certain financial needs you need to take into consideration, which makes the impact of impact investing an important part of the wealth management process. So what we're looking for here, and let me just highlight a couple things, is this is our portfolio as of 12/31. At a high level, you might consider these things as you think about the riskiness of your portfolio. Oops. Is the investment type. Right now, you can see we're about 60% equity and 40% in fixed income. This, I would say, is a moderately risky portfolio. If you want it to be even more risky, you likely see them at 70% equity, 80% equity, and this is across public and private. Now, then you start to dig into, in our portfolio, how much do we want to be in the public markets versus how much in the privates, which is depicted here. And this color coordinates with the colors over here in terms of public-private. And if this was a real Q&A where you could respond, I would ask the folks participating, you know, what determines how much into public versus how much into private you would want to put your assets? And for us, it comes up of how much liquidity do you need in your portfolio? And as a foundation, we don't have a ton of liquidity needs. Now, we also want to be in the private markets more so because we feel that that is much more direct impact. Adam touched on ESG versus SRI, responsible values alignment, and impact investing. We view the private markets really as direct impact, and we view the public markets as collective impact. Our dollars aren't going to make a huge dent in the $80 trillion of publicly traded securities around the world, but if we were to invest with like-minded investors, those that we meet through Toniic, managers who have, you know, rigorous ESG screens in their portfolios, then we can have collective impact because we're all working towards the same thing. So let's start with our public portfolio. If you click on this, you'll see the liquidity over here is typically daily because they're publicly traded securities. You'll see that it's predominantly in public equity as well as public debt. And then we have some stuff in cash, which is the red there. Obviously, you need cash as things come in and out of your accounts. And then if we were to look at the impact of these things, folks may have heard of the many industry classifications of how you can quantify impact. At a high level, we like to look at the SDG classifications and the IMP classifications. SDG stands for Sustainable Development Goals from the United Nations, and IMP is the Impact Management Project, which is fairly new compared to the SDGs, which were founded in 2015. And then other things like the IFC, the Global Impact Investing Network, B Lab has their gears ratings. That's the impact part of things. Now, I would step back and say, okay, how did we pick these specific themes to focus on? And this is advice I'd give to any investor, and one that we got from a Toniic member is to really focus on things that you understand. Folks will come to me and say, hey, we got this great tech platform, here you go. And then somebody else will say, here's something else. Okay, that other one has 10 components, this one has 12. And we couldn't tell you why those 2 extra components are better than the one with just 10. So we're not tech investors, but what we do know is financial services, and we do know the fashion space. So we tend to focus from an impact perspective on economic opportunities for women globally, which you'll see represented with that goal 5, as well as, and goal 8, which is economic opportunities under the SDG classification, within the sectors of financial services and ethical fashion. And that's because my wife came into the fashion industry. Her mother was very focused on issues pertaining to women and girls throughout her entire life. And then her father founded a financial services firm, which he sold in 2006. So it really just brought the whole family's impact themes together under this portfolio. So if we were to look into, on the left side, these different managers, these types of managers all have some type of a gender lens screen to that investment strategy. Something like a Breckenridge, which is in the public debt markets, has a gender lens screen as well. If we look at Boston Common, we were intrigued because beyond just the screen, it was a female-run strategy with a female at the helm as CEO of Boston Common. So not just within the investment, but again, going back to being present in the various ways you could look at impact within one investment. Anything to touch on here? Oh, so I would say we are on a journey to be 100% all in on impact. Beneficial State Bank, we think, is an impactful institution. These very last 2, Fidelity Money Market Treasuries, could we honestly say that's impactful? It's tough. It's tough, right? You need that cash to sweep into different investments, and only these kind of larger institutions have the ability, as well as the, I guess you could say, the connections to the other managers we're with to use that sweep cash. So I would say that it's not super impactful, but again, it's collective impact on the public markets. If we were to dive into the private markets, this is what gets me going. I started private equity at a firm called Hamilton Lane. I feel like we do a lot of the private investing in-house, and we look to invest in things beyond the dollar, to say, hey, here are funds, but then how can we help your company grow and be successful? And just like anything, success isn't linear from a financial or an impact perspective. A lot of folks will say, hey, we want to see more women representation in your supply chain, which is something that we've typically said. We've invested in companies where the supply chain included about 70 to 80% women, but then as the company grew, to their credit, became much more successful. They started making more complex pieces. The percentage of women in the supply chain ended up decreasing, although the overall supply chain was increasing. So we like to say that profits can be a proxy of impact as long as the impact is directly correlated with those profits. But in this case, it was negatively correlated. So it was kind of going up, but at a decreasing rate. And so we had to step back and say, okay, how do we think about this? We think overall it was a good thing. And the company made a commitment to train more of the female artisans in the African country it was doing business in to do more of the complex pieces that they were trying to create and sell in the West. And this is going into impact measurement a bit, and I'll touch on a bit why I'm not sure standardization. I think standardization would be amazing, but I'm not sure how it will actually happen, because impact is so personal. I could look at this portfolio and say, wow, it's so personal to me. How does it resonate with you? But if you're an environmental focused investor, you might say, well, gosh, this is really missing what I care about. This is really focused on the S type of investments. So I'll step back to the high level of the portfolio and just go over things briefly. So we're about half in the public markets, half in the privates. We probably have a bit too much liquidity because we don't have too many liquidity needs. So we can put more into the private markets over time. You can see our asset class wheel is broadly diversified: public equities, direct equity, private debt, and public debt. The IMP classification tends to be on this C4, which, if folks aren't familiar with the IMP classification, C4 is right here. So they're private investments in businesses that have a significant effect on income and employment for underserved people. Typically, our portfolio exposure to this C4 tends to be in emerging markets, which is where we have a lot of our assets. That's our website. And then as you can see, we're broadly diversified around the world. We have a large exposure to North America here. That's because of the publicly traded assets, financials, because that's really the sector we understand. But again, stepping back to being traditional investors, we're very focused on broad diversification because of the risk protection that gives us. If something happens in one part of the world, this portfolio touches approximately 70 countries. So we're kind of held up by economies that are doing well elsewhere. And that's both developing and emerging economies. Okay, I'll stop talking. And what I want to say is all of these companies that are here in our portfolio, it's about 30 active ones. If you go to our website, cordisfoundation.org, you can see all of those here and just drop down into private equity, see the types of funds, check out their websites if you wanted to. And if you're interested in checking out the philanthropy that we do as well, that's another page on our website here where you can check out our grantee partners, and we've bucketed them into these sectors. So let me look at some of the questions. I see some come in, and maybe Adam, we can tag team these questions together if you like.
Yeah, let's turn it back to you, Sayuri.
Yeah.
You could turn your video on, and we'll stop sharing, and we'll follow your lead.
All right. Hey, by the way, thank you so much, Eric and Adam. Hey, and Eric, are you sure you didn't go to MIT? I mean, all the analysis that you've done.
I tried. I don't think I got in.
It is so helpful to kind of understand how you build overall impact portfolio in all the different asset classes. And let me just say that I am aspiring to be Eric. So let's take the questions one at a time that has come in. The first question is, do impact enterprises, the target firms of impact investors, tend to be B Corp certified or align similarly transparent accountability models? Maybe Adam, you can take this one.
I think Eric will have a view on this too, which I'd actually like to hear. My answer is broadly yes, though not necessarily specifically one. So we're big fans of B Labs and the assessment that they do. It's a very broad and thorough investigation of the potential impacts of an enterprise, and companies that have aligned themselves against the B Corp standard stand out for impact investors. On the other hand, not every investment that I make or that impact investors make will be into a B Corp or somebody else who has such a certification. There are many competing standards, but the commitment to transparency and frankly, the amount of work that it takes to go through the B Labs assessment is a real indicator for an investor that this is an enterprise that takes that level of accountability seriously. So, Eric, do you have anything you would add?
Yeah, I'd say I love the B Lab certification as well. I think when you sign up to be a B Corp, you're saying, hey, here's my intent to do impact. I'm committing to measure that impact, and I'm going to report back on it. And there's a GIIN score that's associated with your company in particular. Now, there were like 100+ companies who said it's not just about profits. Recently at the business roundtable, they said, here's our new mission. It's not just about shareholders, it's stakeholders. What I'd love to see, and B Lab has publicly come out and said this, is how do we hold them accountable? Well, why don't they all commit to becoming B Corps? Because it's not just intent. They've expressed intent. Now I'd love to see their commitment to measure, and I'd love to see the reporting piece of it. And that happens as a requirement of being a B Corp. So love it. And hopefully more companies will become B Corps. And I just caveat it with, as a small social enterprise, becoming a B Corp costs a couple $1,000s to go through the B Lab certification process. So I absolutely understand and don't hold it against them if they're a growing company and they're trying to say, okay, are we going to make payroll, or are we going to become a B Corp? So just want to put that caveat in there.
Okay, thanks, both of you. Let's go to the next questions. So this question says, the finance friends I talk to, the ones who are involved in daily trading, basically roll their eyes when I mention my interest in impact investing. I'm surprised by this. Can you talk about how to articulate the importance of this? Is this the future of investing? I think so, but they who are more professional than I am in the investment world don't seem to.
We love this kind of question, don't we?
Oh, yeah. Maybe we'll go backwards. Let me take this and we'll popcorn over to Adam. But I'd say it's 75 years ago, publicly traded companies weren't required to disclose their profits. They viewed it as confidential information. And then it ended up ruling, the government, that, hey, this is deemed material, not proprietary. Material meaning if an investor had this information, it would affect the way they thought about the value of your company. And today, you can't think of investing, I can't think of investing in a company without understanding its profits. So I think impact investing is just extra data that we're now increasingly having access for, and it's data being input into the friends that you have, into their models. And I think them rolling their eyes is then just not clearly understanding that the data is becoming more and more available, and that may be understanding how to fit it into the models they have today. So I think and I think there was like 50 plus or 100 plus bills in Congress today talking about environmental protections and things that have to do with ESG. So I think you're having a lot of demand for this data because investors are saying it's material. And I believe it's only a matter of time where companies are going to have to disclose these ESG data points. And then your friends, the traders, are going to put these data points into their analysis and make better investment decisions.
So great answer. I'll just add a couple points. One is that people are very stuck in their grooves. And so this is not just investing, but life, right? People get into a pattern. And one of the patterns of thinking in the modern day is the only thing that matters in investing is how much money you make and how much risk you're taking, and perhaps liquidity, right? But that everything else to that just doesn't matter. So if you start from that worldview, then you're going to quickly dismiss impact investing as incorporating a bunch of irrelevant subjects. But as I think those who perhaps aren't financial professionals can recognize, the financial profession has not always steered us so well as a society. And the focus on short-termism, on the next quarterly earnings report, the ignoring of the giant problems that are looming down on the earth, which many of us believe business has not only a responsibility, but a great opportunity to address, is sort of beyond a shame. So I think the first thing is that it's a habit of thinking. And it also is tied a little bit to this myth that I alluded to when I presented that all impact investing is concessionary. And that may also be leading to the eye rolling. Again, this habit of thinking you should make as much money as you can, and then you'll have more to give away, even if the money that you're making is causing more harm than the good that you're doing with your grant making or your philanthropy or whatever. So I view the eye rolling as people who are stuck in an old paradigm and have not recognized what's happening more broadly. I mean, just very quickly, the Financial Times has recently started a project called Moral Money. Many mainstream financial institutions, financial publications, and other observers of the space see the trend towards at least sustainable investing broadly as one that's gaining a lot of steam. So financial professionals who are ignoring that trend are doing so at their peril.
Great, thank you. The next question, when you refer to a journey of 100% impact, how do you rank non-financial assets, real estate namely? Would you exclude or search for impact-related assets as well? Who wants to take this?
I'll take this one. Would you exclude or search? I'm not sure I understand the last.
I think that the questioner may be thinking that for impact investment is it doesn't include all asset classes, including real estate and others.
Okay. So in general, it does. We think about it as your investment portfolio. So for example, your personal home would not be included in your investment portfolio because it's just not typically looked at that way. And so we wouldn't ask you to classify that as investment, as impact or not. But basically all discretionary investments that are, or assets that are held with the primary purpose of return are included within the scope. And thus, as we've seen, there are, or as we've alluded to, I guess we haven't gotten very deep today, but there are strategies for investing with an impact lens in every single asset class that an advisor like Align Impact will guide a client through. So it's very much across all investable assets.
Eric, do you want to add something?
I think I'd add it goes back to that time, talent, and treasure right being present in your decision making. So if you are going to buy a new house, you may look at the carbon footprint, you may look at using clean energy. And if you're a real estate investor, so looking at a bunch of different properties, commercial and residential, then yes, I think you look at it as a piece of that portfolio that's maybe uncorrelated traditionally to, you know, the publicly traded stock market, things like that. So yes.
Okay, next question. Is there a widely recognized way to measure the impact of an investment? Eric, you want to take that first?
Sure. Yes, some of the ones that we mentioned today. So the IMP, which I see we had someone from the Impact Management Project on this call, which is great. I'd say B Corps and the GEARS ratings is pretty prevalent today, but not as wide as we'd like to see it. The Global Impact Investing Network has what's called the IRIS metrics that they continue to revamp on an annual basis. I think we're on like version 5.0. Those are like 400 different metrics you can choose from. The IFC just came out with their principles on impact investing, and they joined what used to be called the United Nations Principles, PRI, the principles for, what is it? Principles Reporting Impact?
Responsible investing.
Principles of Responsible Investing. And so that's a membership network, just like a B Corp, where you pay a certain amount of money and then you commit to measuring and reporting on your impact. So I'd say the IMP, IFC, PRI, GEARS and B Lab, and then the IRIS metrics from the GIIN, those are like 6 different ones. I see, and then the SDGs really are a classification, not necessarily we have measuring, and I think you can bucket them into things. But to me, I think that it's great to have wide standardization, because I love the saying, data just doesn't measure progress, it inspires it. And if your data and impact reporting can inspire others to move in this direction, then hey, that's successful. But ultimately, as the investor, those metrics are only as good as it inspires you to either make decisions differently or do more of this type of work. So maybe that's a long way of saying there's a couple really great frameworks. A lot of people are using a lot of them. And I think like any industry, it's going to hopefully consolidate into, hey, here's the standard we're all trying to use.
Adam, do you have anything else to add on that one?
Yeah, great answer.
Okay. All right, so the next one, what about the folks who say that there are issues with many of the sustainable organizations, that they are not as effective as they're claiming? How do I make sure that the orgs I invest in are really, really doing good? All right. Who wants it?
Why don't you go ahead, Adam? This is a fun one.
Yeah, so what I would say in response to this is, thank you for thinking about it in that way, right? Because I think we are not yet at a stage, as Eric described, there are many different ways to measure impact. We haven't yet resolved impact down to a single statement, like we see with generally accepted accounting principles or IFRS outside of the United States. But that process of developing generally accepted accounting principles took perhaps 100 years. And the impact investing, the sustainable investing industry more broadly is much younger than that. And so we're really at the birth of the development of processes and methods for determining the overall impact of an enterprise. And the tempting thing is to write an impact report if you are measuring your impact, to write one that really highlights your successes, and to sort of cherry pick and not pay a lot of attention to the things that didn't work out as planned, not to mention unintended negative impacts. And so I would say candidly that the field is still in the early days of being able to help you answer this question: how do I know that the organization I'm investing in is really, really doing good? And I think that problem is scales with the size of the organization. So assessing the overall impact of a relatively small social enterprise is a much simpler affair than assessing the overall impact of a global multinational corporation. And as we've said, these impact investments are across all asset classes, so we need a way to do that across all, public and private and so forth. We aren't there yet, but that's not a reason to try, nor a reason to, and so we encourage people to use various tools, and I think over the coming years we will see increasing precision in the ability to answer that question.
Okay, I think we're gonna, Eric, do you have something short to add before?
Yeah, I would just add that, there are issues with all organizations, whether they're impact or not. And traditionally you have these auditing firms that can say, hey, this is correct. We don't see that on the impact side yet, right? You haven't seen people like Ernst & Young does a little bit, KPMG, but we believe that some of these companies are directionally correct. But that's the best we can do right now when it comes to impact measurement. But I wouldn't look at it as, oh, it's the sustainable organizations that aren't as effective as they're claiming. I think that could be said about any company claiming to be good at anything. So it's just doing your homework and making good choices.
Great. Thank you so much, Eric and Adam. And I am proud to say that I hang out with these guys. These guys are my tribe in impact investing. And I've been in Toniic for a year and a half and have gone through such learning and kind of broadened my scope of impact investing. So what I'd like to encourage is, it's not for everyone to join Toniic, but let's create a tribe around MIT community. And again, the invitation is not just for people that went there, but kind of community at large, using MIT as a forum to develop our community. There are certainly lots of social entrepreneurs coming out of MIT. I would say that 4 out of the 7 of my pre-seed investments are folks that are affiliated with MIT, and that was not totally on purpose. So again, thank you everybody for participating, and please look into joining SEAG, LinkedIn, or the MIT Alumni Club Network connection, and we'll see you again soon. And again, Eric and Adam, you guys are wonderful and so special.
Thanks for joining us. And for more information on how to connect with the MIT Alumni Association, please visit our website.